Apple stock is up 7% in after hours after the company reported its second quarter earnings results. So far, the market seems pretty impressed with Apple's overall report, which I do find quite interesting, as Apple's numbers did not seem too impressive to me. So as promised, in today's video, we are going to discuss Apple's earnings, why the stock is spiking, and if the stock is looking like a buy after earnings. And with that being said, let's just dive right into the video. Alright, so as always, I have some screenshots from the overall earnings report that we are going to go through. But first off, Gurgavin did report that Apple earnings just came out and the Q2 revenue came in at $90.75 billion, which was above the $90.5 billion estimate. So Apple did beat revenue estimates. Apple's Q2 earnings per share also came in at $1.53 versus $1.50. So earnings per share did also beat estimates. And in my opinion, this is the number one reason why the stock is up in after hours trading. So now let's head over to Apple's actual earnings release. And right here, this says the Apple board of directors has declared a cash dividend of 25 cents per share on the company's common stock, which is an increase of 4%. So Apple also increased its dividend by 4% in this quarter. The board of directors has also authorized an additional program to repurchase up to $110 billion worth of the company's stock. So Apple's board of directors just approved a $110 billion stock repurchase program, which is absolutely massive, okay? But the funny thing is, Apple is now a $2.8 trillion company in after-hours trading. So $110 billion of buybacks is only roughly 4% of the company's shares outstanding. So $110 billion may sound like this massive, huge buyback, but in terms of the percent yield that the shareholders are actually going to get, it's not really that massive. It's still great, don't get me wrong, but it's not like this massive buyback that is going to create a ton of shareholder value. So now let's head over to Apple's income statement. And right away, we can see that the total net sales came in at that $90.75 billion, which is actually down about $4 billion year over year. So Apple's revenue actually declined year over year in the second quarter. Product revenue came in at $66.9 billion, which is down roughly $7 billion year over year. However, services revenue came in at $23.9 billion, which is up roughly $3 billion year over year. So Apple's services revenue is increasing very nicely. Now, what's also nice about the services revenue is we can see right here that the cost of sales did actually not really grow year over year, and it was basically flat. So Apple's services revenue increased by roughly $3 billion year over year, but the cost of sales for this business or for this revenue did not go up. And overall, what that means is the services revenue margin is continuing to expand, and this revenue is much more profitable for Apple's overall business. In fact, even though Apple's revenue was down roughly $4 billion year over year, its overall gross profits did increase by roughly $300 million. So the gross profits are up despite the revenue declining, and that is because the services revenue is so high margin. However, Apple's operating income did decline by about $400 million year over year, and the net income also declined by about $500 million year over year. So operating income and overall net income did decline. Now, what's interesting is the earnings per share on a fully diluted basis did come in at $1.53, which is a growth of 1 cent year over year. So we can see that the earnings per share actually grew despite the overall net income declining. Now, how this happened is because Apple is buying back a lot of shares. As we just saw, they just announced another $110 billion share buyback program. And as the shares of the business decline, the earnings that the business generates is spread over less and less shares. And the ultimate result of that is the earnings per share can grow despite overall net income not actually growing. And this right here is one of the main benefits of share buybacks. You can actually see your per share profits increase despite the overall business's profitability not really growing, which is exactly what is happening over here with Apple right now. Now, moving on to the next screenshot, this one shows us the different net sales by reportable segment and by geography. So right here, we can see that Greater China sales did decline by about 1.5 billion, Japan sales declined by about 900 million, and then the rest of Asia sales declined by about 1.4 billion. Sales in Europe were actually up, and sales in Americas were down slightly year over year. So basically, in all of Apple's markets outside of Europe, it did actually see its revenues decline year over year. Now, in terms of its different products, iPhone sales were down roughly $6 billion year over year. So iPhone sales have had a really rough year so far in 2024. Mac sales were up roughly 300 million, and iPad sales were down roughly 1.1 billion, and wearable sales were down roughly, $800 million. So the iPhone, iPad, and wearable segment of Apple's business are actually seeing a decline year over year, with the iPhone sales being down the most by far. Now, moving on to Apple's cash flow statement really quickly, we can see that they did generate operating cash flow in the first 6 months of their fiscal year of about $62.6 billion, which is basically flat year over year. So in terms of operating profits, Apple's operating profits are actually not really growing year over year. One thing that I do like about Apple's business, though, is that the stock-based compensation expense is roughly $6 billion, which is less than 10% of the company's operating cash flow. Now, in terms of the largest businesses in the world and these massive mega tech companies, this is actually a low amount of stock-based compensation relative to the profits that the business generates. So Apple is not doing a massive amount of stock-based compensation relative to profits, which I do think is a good thing to see. What's also great to see is Apple's capital expenditures are only $4.4 billion in the first 6 months of its fiscal year, relative to $6.7 billion last year in its first 6 months of 2023. So the capital expenditures for the business have declined by about $2.4 billion year over year. And capital expenditures of $4.4 billion to produce operating cash flows of $62.6 billion is actually pretty dang impressive, which also means that Apple's business is an absolute free cash flow machine, and it is a free cash flow beast, okay? So in the first 6 months of its fiscal year, it has now generated roughly $58 billion of free cash flow, which is just insane. Now, at the bottom of the cash flow statement, we can see that Apple has paid out $7.5 billion in dividends and bought back $43.3 billion of stock so far in its fiscal year in the first 6 months. And this is where the company's free cash flow is going, is it is going to paying dividends, and then the vast majority of free cash flow is going to buying back stock. That is pretty much what Apple now does with all of its free cash flow. All right, so now let's head back over to Stock Unlock and do some calculations to figure out how is Apple's business being priced today after the market close. So before the market close, Apple's business was selling for $2.61 trillion. Now the stock is up 1.071%, which means that its market cap is basically $2.8 trillion in after-hours trading now. Now, in the trailing 12 months, the company has also produced roughly $109 billion of free cash flow, which means that the business is selling for a price to free cash flow of about 25.64 today. So that is the price of this business. Now, additionally, what I want to do is head over to our analyst tab here, and I want to take a look at the compounded annual growth rate estimates, the analyst estimates, for Apple's revenue and earnings per share over the next 5 years. So analysts are expecting Apple's revenue to compound by about 7.45% annually over the next 5 years to 2028, and earnings per share to compound by about 9% annually to 2028 as well. Now, the reason that the earnings per share is projected to compound faster than the revenue is again because Apple does buy back shares. And due to them buying back shares, the net income can grow faster than the overall revenue on a per share basis. So these are the growth rates that analysts are projecting for Apple stock over the next 5 years. So now let's go and take a look at Apple's price to free cash flow versus its history. And again, it is trading for about 25.6 now in after hours trading. And we can see that its 10-year average has been about 18.5. So Apple's price to free cash flow today is actually quite a bit above its historical averages, and it is trading right near its high end. The highest the stock has ever traded for was about 30 here in December of 2021, which was also when the market was in a little bit of a bubbly period, when the spec stocks were really rallying and going crazy. So Apple is actually right near the high end of its price range, and it is trading well above its historical averages, which does lead me to believe that the stock is actually quite expensive today. Now, even if we don't take a look at Apple's price relative to its history, this is still a business that is trading for a price multiple of 25.6 today, and it's projected to grow its revenues and earnings by about 7 to 9% annually over the next 5 years. So that's a 25 to 26 price multiple for about 7 to 9% growth, which I do think is actually a high price to pay for a little bit of revenue and earnings per share growth, which also leads me to believe that Apple stock is actually quite expensive today as well. In fact, we can do a quick discounted cash flow calculation of Apple stock to see what kind of returns investors can expect over the next 5 years based on analyst estimates of EPS growth. So we are going to use Apple's net income and earnings, and we are going to throw in that 9% annual growth rate over the next 5 years, and Apple buying back about 3% of their stock over the next 5 years as well. The dividend we are going to say is going to grow in line with the overall earnings, so about 9% annual dividend growth as well. And we are going to say that Apple is going to trade for a price to earnings ratio of about 20, which is more in line with the company's historical averages. Now, when we enter in these metrics, which again are based on analyst expectations, we get a compounded annual growth rate of about 6.76%, even including the dividends paid. So if the analyst estimates are met and Apple's price ratio does contract a little bit to come more in line with how the business has traded historically, then the stock will not produce massive returns for shareholders over the next 5 years due to how high the price is today. And price is very important and something that I do focus a lot here on in my channel. So what we can actually do is increase the price ratio to figure out what price ratio Apple would have to trade for to produce a 10% compounded annual growth rate. And the price to earnings ratio that Apple would have to maintain is 23.3 over the next 5 years and meet those analyst expectations to produce a 10% compounded annual growth rate. Now for me, a 23 price ratio for 7 to 9% growth is still on the higher end. So I don't know if Apple is going to be able to maintain this over the next 5 years or if the price ratio will come down to its historical averages. But overall, I am not as confident as analysts in Apple's business going forward in terms of its growth rates. And I am also not as confident in the overall market to continue sustaining Apple's high price today over the next 5 years. So for those reasons, I actually do think that Apple is more on the expensive end today, and I am personally not looking to buy Apple stock at its current price, especially with that boost to the stock price in after hours trading. I mean, ultimately, Apple is struggling to grow its revenue, and the earnings per share growth is actually just coming from share buybacks, because operating income and net income did decline year over year. So the business does seem like it is seeing some weakness right now, especially across the world over in the emerging markets, which is something to take note of. And for a business that is struggling to grow its revenues right now, I do think that a 25 multiple is on the higher end. So I am not going to be buying Apple at the current price. It is a stock that I do watch, and if the stock ever did get down to a more sane price, then I would consider it. But currently it is well above what I would consider fair value. And for those reasons, I am going to just keep it on the watch list for now. But with that being said, that is going to wrap up the video. This is going to be a quicker one, just covering Apple's earnings. And if you did enjoy this video, then please remember to leave a like on it. It really does help out my channel, and I truly do appreciate it. Also, if you're new here and you want to stay up to date with all of the earnings reports coming out and everything going on in the market, then please consider subscribing to my channel as well, because I do my absolute best to get these videos out as quickly as I possibly can to give you guys as much value as possible. But again, that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next one.